Good morning, good afternoon, good evening, wherever you are, whenever you are. Hello, thank you for watching my videos. It's Mike, it's April 20th, 2009. Reinhardt has been at it again. His latest prediction, which has been up for the last couple of weeks on his website, enterprisecorruption.com, seems to indicate there will be a swing in the stock market beginning May 11th, 2009. Now, there's been a lot of speculation as to what exactly will trigger the swing. Perhaps one of the things to be watching for is something that Hal Turner's blog has been going on about for the last day or two. Hal Turner apparently has been passed a secret document. Essentially, it's the preliminary stress test results. Back in February, the United States Treasury determined that it would be a really good idea to do stress tests. Now let me just pull up the original comment here. Stress tests for the banks, essentially to sort of figure out, do the banks have enough capital to handle a sudden swing in, for instance, unemployment, or a sudden increase in the number of defaulting mortgages. And what they're going to do is use some mathematical modeling to determine if the banks are capitalized well enough to handle dramatic swings. Now, the original numbers used in the beginning of the tests in February indicated a maximum unemployment rate of roughly 9%. Well, we seem well determined to surpass that number, probably by a considerable amount. So the stress tests are going to reveal some rather interesting results. Now, Hal Turner's blog site, which has been linked here, indicates that at the current levels, with the most dramatic stress tests, 16 of the 19 banks on the list being tested are technically insolvent or will become insolvent. Now, this was picked up by the Financial Times this morning in the Alphaville site, Alphaville blog, essentially saying that trying to discredit this information. Unfortunately, it worked in the other way. The United States stock markets swung immediately upon opening. They too are worried about this particular set of events. Now, an earlier posting in the Alphaville website from April 5th, banks passing stress tests, but you're not allowed to know about it. Now, essentially, there was an initial report, April 9th of this year, basically saying that it looks like they're all set to pass the government's stress tests. From the New York Times, for the past 8 weeks, nearly 200 federal examiners have labored inside some of the nation's biggest banks to determine how these institutions would hold up if the recession deepens. What they are discovering may come as a relief to both the financial industry and the public. The banking industry, broadly speaking, seems to be in better shape than many people think. Officials involved in the examination say. So back on April 9th, they had the preliminary results. Now, what's been happening on the Hal Turner site is basically detailing that the United States Treasury has come out and specifically said there is no basis to report on the bank testing. U.S. Treasury spokesman said there's no basis to a blog posting that buffeted financial stocks. Andrew Williams, a Treasury spokesman, dismissed the report from Hal Turner, particularly given we don't have stress results yet. Well, yes, the official results are not due until at least May 4th. Now, more than likely, what will happen? Leading up to May 4th, the government will come out with some garbage here and there, trying to make people feel better about these banking stress tests. Trying to lay the groundwork, saying, yes, it's bad, but it's not as bad as it could be, for instance. Now, my best bet is they're going to delay the release of the data. May 4th falls on a Monday. It would be highly unwise for the United States Treasury to release this data on that day. Now, one of the things that's been happening is the Treasury and financial regulators are clashing with each other over how to disclose results from the stress tests, with some officials concerned at potential damage to weaker institutions. Now, this was published April 18th, so they have an idea of what the results are going to look like. They're just keeping it kind of hush for now. And other reports, U.S. walks tightrope over bank stress tests. U.S. lays groundwork for bank stress test release. All of these articles are linked over here. So it would appear the Treasury and the Federal Reserve and regulators all over the world already know the results of these stress tests. They're trying to find a way to sneak it out. So if they do release it the week of May 4th, I would suspect they release it near the end of the week, which could potentially send things into a bit of a spin. Now, today's blog release has been picked up by a number of different newspapers. The Globe and Mail has it, etc., etc. Now, an earlier piece, February 17th, basically quoted William Black. William Black is a former bank regulator, best known for his thwarted but later vindicated efforts to prosecute savings and loan crisis fraudster Charles Keating. He is currently an associate professor of economics and law at the University of Missouri, Kansas City. His quote in February 17th is, "There are no real stress tests going on." And basically he asserts, if you did a real stress test, as Geithner explained them, you wouldn't have just a $2 trillion hole. You'd expose regulatory capital requirements of 50%. You can't conduct a meaningful stress test without reviewing, sampling the underlying loan files, and it seems likely that the purchaser of securitized instruments do not even have the loan file data. This is a very interesting little point here. If you're running into kind of financial difficulty and you're having difficulty paying off your mortgage, what I suggest you do is contact whoever holds the mortgage and ask for a copy of the original paperwork. If they can't provide it, they have no legal right to the money you're giving them every month. Think about that one, folks. Anyway, but some other stuff. Stress test for banks exposes rift on Wall Street, February 24th. Big banks keep insisting they have all the capital they need. However, what kind of capital is it? This is the way they're going to trick you. The capital they have is not what's called Tier 1 capital. This is capital that's been raised on secondary markets through debt obligations, which will, funnily enough, come due again. A couple more articles linked. JP Morgan came out with a report today. Banks likely face $400 billion more in losses. They're trying to get you ready for it. And Turner Radio posted a later entry on their blog. U.S. Securities and Exchange Commission calls the Turner Radio network about a stress test story. Evidently, this afternoon at approximately 3 p.m. Eastern U.S. time, Turner Radio Network received a call from John Polesi at the United States Securities and Exchange Commission. Basically, wishing to see a copy of the report that has been passed to the Turner Radio Network. Of course, they basically said, do you have a subpoena? And they said, no, what if we got one? Would you give it to us? And the Turner Radio Network replied, well, of course, we would have to speak to our legal representatives, and more than likely we would get the subpoena squashed. Why is the Securities Exchange Commission calling up Turner Radio Network to take a look at the document? More than likely it is real. What's going to trigger this? There's a funny little thing called a quantitative hedge fund. I've included a bunch of links about this. But essentially, there's all kinds of really bizarre activities in money markets right now. And it looks like the quantitative hedge funds are unwinding some of their more aggressive positions, effectively reducing their capital levels. This may well be the trigger. Watch out, folks. May 11th is coming. Reinhardt says it's going to be a bumpy ride. I tend to agree with him. Prepare, folks. If Hal Turner's blog entry is correct, and this little report he's been passed is correct, of the top 19 banks, 16 are already technically insolvent and will more than likely fail. Of the 16 banks that are technically insolvent, not even one can withstand any disruption of cash flow. Where do they get the cash flow from? Weird things like quantitative hedge funds. If any 2 of the 16 banks go under, they will totally wipe out any remaining FDIC insurance funding. Of the top 19 banks in the nation, the top 5 are undercapitalized so dangerously there is serious doubt about their ability to continue operating as ongoing businesses. And further, 1,816 banks and thrifts are at risk of failure, with total assets of $4.67 trillion. It's going to get very, very scary second week of May. Okay, folks. Peace, love, understanding. Think about things. Be prepared. Bye.